Welcome to the Talking Advisory and Client Solutions podcast. My name is Leah Crowley, and in this series we're taking a look at a range of topics that you might know a little bit about but want to get a better understanding of. We will discuss a range of topics like buying and selling a business, valuations, due diligence, debt advisory, sustainability, financial transformation, and a whole lot more. In this episode, we've got Nicholas Guest back again, partner in advisory, and also Joel Dare, partner in tax consulting from HLB Manjard. How are you both again?
Leah, great to be back.
It's great to have you guys back.
Good to see you again.
Wonderful. Great outfits.
Thanks, Leah. Dressed appropriately for the weather today.
Now, last episode that you guys were on, we were talking about due diligence, but this episode's a little bit different. We're going to have a look at tax and structuring considerations when you're buying a business. So a lot more to do with your side, I would imagine, Joel, of the whole process.
Yeah, it's where I get really excited when we get down to the structuring part.
Oh, okay. Look out, Nicholas. I don't know if you're allowed to say anything in this one.
I see the eyes light up on the tax people when we talk structuring.
I have a very interesting life. I know what you're talking about.
It's just you're passionate, that's all.
Yes.
It's just you're passionate. All right, so let's crack into this. So you've identified the business that you want to buy or acquire, right? And you've started to negotiate the terms of acquisition. What do you now consider?
Oh, this is when it gets interesting.
Yeah?
What are we buying? Is it a business in terms of the assets of the business? Is it the shares in a company? How has this business operated historically? And which parts of that do we actually want to buy? Because there's a few different options that can be explored. So that's what we would have got some understanding from via the due diligence process. And now we start to form our ideas around what exactly it is is either being offered for sale or that we particularly want to buy. That can have some quite significant outcomes, or different outcomes, depending on how that is approached.
Yeah, I bet, because if you're just looking to buy the majority shares, well, that's a lot different to I'm going to buy the business with all the employees attached. Not that you're buying employees, but you know what I mean.
There is, and there's different commercial considerations in terms of if there's licenses in place or some agreements in place that need to be transferred or novated during that purchase. There's also some value considerations because we might not want to acquire everything that the historic business has operated. So how much we're going to pay for the bits that we want come up into the consideration as well.
So if you're looking to acquire the majority of whatever this business is, but you don't want those little bits, what happens to those little bits? Do you sell them, or do they sell them before you acquire the whole business? Like what happens?
Well, that's, I suppose, Leah, where you start to get into the discussion between the parties around which way to structure it. So it could be, for example, that the unwanted assets are flipped out of that particular structure, and your purchaser looks to acquire the structure with all the things that are of interest in there. Alternatively, it could be that you, for example, purchase all of the assets of that business that are of interest, and you leave behind inside the shell those things that you're really not interested in having a look at. And that's just the commercial aspect of it, I suppose. But tax will usually have something to say around which version of those that you do, because often there's a lot of importance both for the purchaser and the seller around what are you buying. So you do get quite different tax outcomes that will come out of buying a series of business assets versus buying shares or units in the unit trust. And that will also have ongoing tax implications for what happens once you've purchased this business or the shares.
I'm just wondering if there's at any point during this process where you could have a second buyer buying other parts that you don't want. Is that a thing?
Yes, it is. And sometimes that's purposely lined up to happen that way during the negotiations with the seller, understanding what their motivations are. And look, there may be some parts of their operations that they're interested in hanging on to, or if it becomes clear that the buyer doesn't want to take on the risks or just certain aspects of those, we can go about finding another party to come in and help there. So with that structuring, that there's both a risk mitigation and avoiding potentially taking on some historic legal liabilities that sit within those entities, but often it is from the tax structuring plays such a significant outcome. And for me, not being a tax expert, I always say that these tax guys can potentially change the deal outcome by 30% just by applying the tax effectiveness of different transactions. So it is the tax outcomes can be quite significantly different, both to the seller and potentially to the acquirer on a go forward basis.
And are they always nice surprises, or?
Well, you're never worse off for having alternatives, and I suppose that there are a range of different ways in which you can buy whatever you're particularly interested in. That just gives your purchaser alternatives, and actually it gives your seller lots of alternatives around how you do it too. And they can have quite different profiles around what they're getting and what they would like to get as proceeds. So look, I think you can get a really unpleasant surprise, but countered with that is if you put in sufficient thought around or shaping a deal in a way which can work well for both parties, then most of the time you get to a situation where whatever those risks or hazards are as a negative surprise, you can work with them, work around them, or deal with them in some other way.
Yeah, right. Why do you get a better transaction from running like this kind of tax? What would you call it?
Well, look, tax is a funny thing in the sense that things that look pretty much the same often have quite different taxing outcomes. So look, just a really simple example here would be often you'll have businesses conducted in a company. Now, if you sell the assets that sit within the company, then the company has a range of different tax outcomes. And then if they want to distribute whatever the proceeds are after sale, and that turns into a dividend, and the dividend regime taxes you in a certain way. But under the same thing that we would see if you just sold the shares in that company, you're not taxed on that as a dividend. That turns into a capital gain. And those two different regimes have quite different tax outcomes. And that can depend on, are you an individual? Are you a trust? Are you a superannuation fund? Are you an Australian resident? Are you a foreign resident? And so each one of these will have an impact on the way that the seller sees it. And also the tax profile of the purchaser too makes a huge difference as to what they, at the end of the day, actually want to buy.
So you would have done a whole tax profile beforehand? Is that something that you do, or is it just something that you become aware of whilst you're structuring and sorting this out?
Great question. If we're working for someone who's looking to buy some kind of an entity or a structure, a business or whatever it is, then it's really important for us to understand what the way that the tax situation works for them after whatever the deal is, assuming it goes ahead. And we'll come to understand that. And then through the process of diligence and interacting with the vendors and also with the target entity, you come to get a feeling for an understanding of what their particular tax preferences and profiles are, as in the thing that they want to sell. Do they want to sell assets or shares? Now, sometimes those can be completely opposite, and that's where it will require a bit of innovation so that you get to a deal which is one that is advantageous for both parties and can actually get the transaction away.
Because I would imagine sometimes if all the tax doesn't line up, then the deal can't happen.
That is possible from a pure risk perspective.
Yeah,
so,
okay.
Sometimes as the acquirer, our legal advisors or the financial advisors may be suggesting there's not advisable to acquire the legal structure, the entity or the company potentially that the historic business has been operated because of some historic risks or liabilities that sit within that entity. But the sellers may only be offering the shares in that business, that entity for sale. They might not be willing to entertain a sales structure in another form because, as Joel just indicated, there could be differing tax outcomes for them. So the same headline consideration may be, purchase consideration might be being offered, but there can be quite differing outcomes for that seller on whether we, how that taxing may flow through to them. So it potentially can be a deal stopper. the converse to that it can actually be a windfall for the seller if we can work in conjunction with their advisors to try and maximise the tax benefit to them.
Why is tax structuring transactions harder in the small and closely held space?
Well, Lee, I suppose what we see in that area is, especially when you're dealing with a relatively small deal size, you don't want to spend an awful lot of money on doing diligence for whatever's inside that entity. Now, within the small and closely held space, what we see is there's a much bigger tax preference for people who are selling something to try and sell shares because they get into that CGT regime. And a lot of the time, there's a lot of concessionality around the CGT regime. Sell shares, get CGT. Sell assets in a business, often you end up with a dividend. Not very tax attractive. So people wanting to sell, they are very keen in a lot of cases to sell shares. Now, in the smaller area, oftentimes, commercially speaking, we don't really want to buy an entity with all of its history attached to it. It comes along with all the tax risks or the commercial risks. Now, if you want to buy that entity, you can, of course, but you're going to have to spend, relatively speaking, an awful lot for a small deal to get the diligence and the comfort that you need to make that transaction happen. So I suppose what we see in that smaller bit of the market, that tax and commercial disconnect between what a seller would like to sell and what your buyer wants to buy in terms of the structure can mean that you have to come up with something else that can, I guess, make it palatable for both parties.
What are some examples that would make it more palatable for both parties?
Well, look, just in that example there, if we're looking at something really small, Nick might have his great business, the small business over there, and he's really keen to sell me the shares. I really want to buy those assets, but I don't really want to have his company.
Yeah.
Because I may not have paid all my taxes before.
Or I think Nick's a good guy, but I just can't see all the things that he's done in that entity, or he's been putting his Ferrari in there and whatever it might be.
Because I may not have kept good records.
Yep. Okay.
So I've got all of those things. So we want to do a deal. Hey, Nick, you've got a good business, and you want to sell me those shares. I really would rather purchase the business assets. So we could strike a deal where I say, hey, Nick, look, I'll buy the shares from you, and I'll take the business out. But after that, look, this shell that I have here, I think I might give it back to you, and you can do what you want with it because I'm not interested in that bit. Another one would be, well, look, Nick, I really have to buy this entity and take all the risk with it. But what I'm going to do is I'll buy it in a company structure, and I'll elect a thing called tax consolidation. So it gets treated just for income tax purposes as a single entity. And I'll just leave it there. I'll transfer out the assets so that all of that historical risk can sit just down in a level down from where all those valuable assets that I'm really interested in. So I don't have to say anything disparaging about Nick or what he's done with his business, but we can come to a deal which effectively it suits Nick because he sold what he wants to sell, and I've managed to manage my tax risk position effectively and in a way which is complies and it's done in a way which is appropriate and correct.
So where does the Ferrari sit now?
I never knew I had it.
Well, actually, Lee, it's a good point is that I have actually gone through transactions where, there's been a vendor there who has a car sitting in there, like a $500,000 car, and you get all of the diligence done around the car, and what does all the structuring come down to? How is that $500,000 precious car going to come out and not muck up the complete deal? So it's funny how, like when you're buying a business, there's all the things that you're really not interested in looking at or dealing with, but oftentimes getting them out of the deal structure takes an awfully long time and a lot of professional effort and care to make sure it's not disadvantageous to anyone.
Yeah, right.
And I think that's a good point because I think most business operators on the whole never go about intentionally, misreporting or doing anything untoward within their business.
Of course.
But we do find that there is such a large number of small and medium enterprises in Australia operated by and founded and operated by a mum and dad or a family unit, and just over a period of time some of those operations can be commingled across either a number of different businesses or some other parts of their affairs. So when it comes time to selling, and they may not necessarily have been thinking about selling their business, it comes to a point where Joel, as the acquirer of this, doesn't really want to be exposed to any of those historic risks, likes the business operations, but there needs to go through this process to try and balance those risk profiles for the acquirer and hopefully get the compensation or the purchase consideration that the seller was hoping to achieve from their business sale.
Going through everything and finding everything must sometimes just be a surprise.
Well, it is, and I think it touches on Joel's point that particularly for the smaller, medium size transaction, to get comfort on every potential risk and because some statutory liabilities go back 7+ years, there's a whole lot of work that would need to be required to get absolute comfort from a purchaser's point of view on those historic risks. So it's potentially by structuring, we can balance or minimise those risks without having to, for the buyer, incur the cost to do the really thorough diligence that would be required to mitigate or minimise the risk.
So I believe earnouts have changed tax treatments. Like, is this a good or a bad thing for you or for them or for everyone?
Well, it's fantastic for the tax advisors because it's become so much more complicated. We have so much more to say. No. So, now, look, there are people out there in the world who do transactions who are not tax advisors, and strangely enough, they're not always better off as a result of the changes. So now, what are they? Changes. So typically speaking, when you do some type of a transaction, the tax impact from that will occur at the time of sale for tax purposes. Now, that can be a real hazard if, for example, you strike a deal where you say, look, I'll give you $10 million now, and if your business performs well, then in 2 years' time, you hit these hurdles, I'll give you another $5 million. Now, who wants to be taxed on $5 million that they haven't seen and might not ever get?
Not me.
Well, it doesn't sound very attractive, does it? Money I haven't seen and be taxed on? Yeah, great. So that was the treatment up until the earnout regime changed to deal with that. You've got something which is you can't work out what it is or if you're going to get it. That's what the earnout is. So it did change in some circumstances to I suppose, mean that if you qualify within the changed earnout provisions, that you won't be taxed in an economic sense until you actually get the money. Okay. And on what you actually get, not what you expect it to get. Now, the real hazard there is that it can be quite difficult to work out whether or not you get into that regime. So you're sort of sitting there going, well, tell me what I need to pay tax on. Is it the $15 million on day one? Or is it $10 million now, and whatever it is, when I get it, then I get taxed on then? And that's what those changed earnout provisions can do. But working out which one you're in, well, that's sometimes more fair, but it's always more complicated.
It sounds way more complicated and almost like a calculated guessing game.
Well, it's even worse than a calculated guessing game. It's all down to language and guidance out of the tax office. Yeah. And a lot of times the only way, and I unfortunately have been through this process and had a few war stories with it, sometimes to work out. So, you're trying to work out, should I pay, when am I going to pay tax on whatever this earnout amount is? And the only way is to really go and ask the tax office. And because it comes down to the way you read the wording there, often it'll take them a long time before they'll give you a response. And deals by their nature, they really need to happen quite quickly or they just don't happen at all. So,
and I think that, Joel, that's another example where the professional advisors working together can try and minimise some of these future uncertainties. So if the legal team's drafting the sale and purchase agreements, coordinating with the tax advisors to try and understand how the commercial transaction which is being structured may flow through from a taxation perspective, and some of that is, as Joel's indicated, can just be language within the drafting of the agreement. So it may not fundamentally change the proposed structuring, but just by ensuring the language within those agreements potentially meets those future taxation objectives as well can be really important.
Am I right in thinking that the legal team would also be poring over these words at this point in time, or?
So the legal team is absolutely essential in terms of drafting the agreements which will be signed between the parties to to seal the deal effectively. The legal experts were thinking from a whole lot of different angles. Sometimes they won't necessarily be coming from a tax first lens, and that's where tapping into the tax advisors can make sure that those considerations for both the buyer and the seller are taken into account.
Yeah, of course. So let's just quickly backtrack a little, and I'm going to ask a question. What does earnout mean?
Well, fundamentally, an earnout is a deal structuring approach where I, as the buyer, may not be wanting to pay 100% of the purchase consideration on day one. And we may agree with the sellers of the business, we'll pay them a portion of the consideration on the day that the deal is completed, and then potentially over the next year, 1 year, 2 years, 3 years, pay them some additional consideration. Now, they may either be fixed components or they may be based on the business continuing to operate and being profitable over those years. So they could be a fixed and potentially variable component of those earnouts. And it's really a way from the buyer's perspective to minimize their risk that the business doesn't operate how they hope it will operate once the deal's completed, and potentially also a way from the seller to maximize their proceeds because they're happy to say, they're confident that the business will continue to perform, and they may end up getting it in total more consideration if they extend the receipt of that over a number of years. And
they're not uncommon, are they, earnouts?
Very common.
Yeah.
Yes. Yeah. It's very common because it gives some comfort to the buyer that they're not paying away all their value on day one for a business which the earnings might fall off the cliff after they've taken control.
Yeah, nice. Are you able to actually leave the tax structuring part of the whole negotiation or the whole process until the negotiations have started?
Look, you can, but it's usually a good idea to get the tax structuring started right at the start of the negotiation in terms of pricing. And look, at a simple explanation for that would be you've got somebody wanting to sell something, you've got somebody wanting to buy something, and they both have a desire around what's going to happen with the amount that's going to get paid for it. It's a lot easier in a functional sense to get the tax to work more efficiently for the person who's selling it than to try and get extra money out of the person who's buying, because that's just the fundamentals of the way the deal works. And so what you can do is that tax structuring can actually be one of the ways by which you can make a deal happen. That is that if say you've got a person who wants to sell a business and they say, well, I want to fund my lifestyle. I need $5 million after, or I've paid all my taxes to go and live after all of this. Now, it's much easier to make the tax work more efficiently for them and to reduce the tax that they have to pay than to try and get your vendor to pay, go from $7 million you purchased to pay, $7, $8, $9 million. It's really quite difficult. So I guess from that, what we see is if you leave tax as a consideration until you get into the diligence process, it's probably a little bit late and it misses the opportunity to either strike a deal which works better for both parties, or if you're acting for a purchaser, to ensure that actually they get better value in the transaction.
So as advisors, would you always be talking to a person who's looking to acquire a business and telling them these are some of the most important first steps, and tax is definitely one of them?
That's our approach, Leah, is as soon as possible. We ask our buyers, do they have experienced tax advisor within their team? Maybe their incumbent accountant, but if they're not, somebody who's experienced in transactions and deal structuring, getting them in touch with someone like Joel, who's deep expertise in that area, really does make a difference to those deal outcomes.
Perfect. So what's your role in structuring with the legal team?
So Leah, when we work with a legal team, it is mostly around making sure that all of those things that have been negotiated through the course of either diligence or the structuring outcomes that we have in mind for both parties to whatever the deal is, actually are reflected in the way that it's worded. So a lot of legal teams, it will be a specialist in corporate law and M&A and transactions. Sometimes they will be aware of the tax implications for both parties, but more often than not, like it's not their bread and butter, and therefore involving tax advisors at that point is really important to making sure you don't end up with any unintended consequences. And also that if you've managed to come up with a really great tax structure that works for both parties, that's actually what the deal that gets recorded in the documentation actually comes into being.
And I think, Leah, it comes back to one of our earlier points about the importance of the team, the advisory teams really circling around the buyer, working together, sharing information, and co-contributing to that final deal structure and what gets captured in those legal agreements, so that we can share our insights and make sure that the buyer gets the best outcome from that transaction.
Yeah, having a team just sounds... it's not going to happen if you don't have a team that works so closely and in synergy with each other.
It is, particularly for most buyers don't undertake too many acquisitions during their careers or their lifetime. So working with some experienced professionals who have a great deal of insight into what can be an optimal outcome can be both more efficient for the buyer, but really gets them the best outcome.
Yeah, wonderful. If anybody's listened to this and thought, I might want to have a little chat with either of you two, easiest way is just to get in contact through the website?
Yeah.
Leah, we're happy to chat to anybody at any stage of their deal transactions, particularly getting started earlier on. There's no obligations to have a chat to us, and we're more than willing to get involved.
Beautiful. Nicholas and Joel, thank you so much for coming on again. This one has been very super informative. I've thoroughly enjoyed it.
Thanks, Leah. It's been fantastic.
Nicholas Guest and Joel Dare's expertise and knowledge is part of HLB Mann Judd's Personal Wealth Management Services. For more information, please visit our website, hlb.com.au.